and welcome back to the channel. Today we're diving into the exciting world of Forex trading with a focus on predicting the impact of CPI news. Now CPI stands for the Consumer Price Index, and it's a big deal in the financial markets. Why? Because it tells us how much prices are changing for everyday things. When the CPI goes up, it usually means inflation is heating up, and that gets central banks like the Federal Reserve all fired up. They might raise interest rates to try and cool things down, and that can impact currency values. Today, we'll break down the key steps you need to take to stay ahead of the market. We're talking actionable insights that you can start using right away to potentially make smarter trades. Let's get started. Alright, let's break down CPI, the Consumer Price Index. It's a way to measure how much prices are changing for a basket of goods and services. Think about things you buy regularly: groceries, gas, rent. The CPI tracks the price fluctuations of these everyday items. When the CPI goes up, it means inflation is on the rise. And when inflation heats up, central banks like to step in and try to cool things down. One of their main tools? Interest rates. Higher interest rates can make a currency more attractive to foreign investors, which can push its value up. If the CPI comes in higher than expected, signaling rising inflation, the market might start betting that the central bank will raise interest rates. On the flip side, if the CPI comes in lower than expected, suggesting inflation is under control, the central bank might hold off on raising rates. It's all about expectations and how the market reacts to those expectations. Now you might be thinking, how do I even know when the CPI data is coming out? That's where economic calendars come in. These calendars are like your trading roadmap. They tell you when major economic events like CPI releases are happening around the world. You can find these calendars for free on websites like Forex Factory or Bloomberg. They list all the important economic data releases, including the date, time, and even the expected forecast for the CPI. If the actual CPI release differs significantly from the forecast, you can expect some serious volatility. So make it a habit to check the economic calendar regularly, especially in the days leading up to a CPI release. This will give you a heads up on potential market-moving events and help you plan your trades accordingly. In trading, knowledge is power, and one of the most powerful tools you have at your disposal is historical data. By looking at past CPI data and how the market reacted to it, you can start to identify trends and patterns. For example, if you notice that every time the CPI has come in higher than expected over the past year, the EUR-USD currency pair has tended to go up, this could be valuable information. By analyzing historical data, you can get a better understanding of how the market might react to certain CPI scenarios. Don't be afraid to dig in, look for those trends, and use that knowledge to your advantage. Central bank policies, the hawks and doves. Central bank policies play a huge role in how currencies move, especially around CPI releases. When inflation is high, they tend to get hawkish, meaning they're more likely to raise interest rates to try to slow things down. On the other hand, if inflation is low, they might get dovish and cut interest rates to try to stimulate the economy. So, it's crucial to pay attention to what central bankers are saying and doing in the weeks and months leading up to a CPI release. Market sentiment. Reading the room. Trading isn't just about numbers, it's about psychology too. Market sentiment, or the overall mood of the market, can have a huge impact on how currencies react to CPI news. If everyone is expecting the CPI to come in hot and the central bank to hike rates, the market might already be pricing that in. Understanding the collective mood of the market can give you an edge in predicting how currencies might react. Technical analysis, spotting the signals. This is all about studying charts and using indicators to identify potential trading opportunities. One thing you can do is look for key support and resistance levels on your charts. These are price levels where a currency has historically struggled to break through. If the CPI release creates a big move, see if the currency can break through those levels. Another useful tool is watching price action around the CPI announcement. Technical analysis is all about identifying patterns and using them to your advantage. Develop a trading plan. Protect yourself. Always have a trading plan, especially when dealing with potentially volatile events like CPI releases. Your trading plan should outline your entry and exit points, your risk management strategy, and your profit targets. Don't just jump into a trade because you think the market is going to move in a certain direction. Have a plan, stick to it, and don't be afraid to walk away if a trade isn't going your way. Never risk more than you can afford to lose. So there you have it. You're now equipped with the knowledge to start predicting the impact of CPI news on your Forex trades. Remember, this isn't a get-rich-quick scheme. It takes time, practice, and a whole lot of patience to master the art of Forex trading. Keep learning, keep practicing, and never stop seeking out new information. Thanks for watching and happy trading.